Okay, so just remind me about the register after we finish, huh? Right. So I want us to start with question 2. Looking at 2024. Okay. So here, maybe let me just switch off the lights because it's not so clear. Okay. Here. First thing, we always go to the required. The first thing they want us to calculate is the following ratios in respect to the year ended 30 June 2023. Okay. The following is an extract from PVC Limited for the year ended 30 June 2023. Okay. So they want us to calculate gross profit margin. Okay. Gross profit margin is the same as gross profit percentage. And here I've just included the formula. Okay, but we should know these off the top of our heads. Okay, at least at this point, because you guys are writing Wednesday next week, isn't it? Okay, which isn't too far away. So let's see. Do we have our gross profit? You guys must did this, huh? So what's our gross profit? We know that it's going to be your sales minus your cost of sales, isn't it? And your sales is 1,680,000. And your cost of sales is obviously 1,008,000. So what was our gross profit? What did you guys get? 672,000. Okay, so there's our gross profit. And so obviously gross profit divided by sales, 672,000 divided by our sales of 1.680,000 gives you what? And then times 100, sorry, after that. Times 100 gives you what? 40%. 40% is our answer there. Then they say, explain the difference between gross profit and net profit, 4 marks. What is the difference between gross profit and net profit? So my advice, you can see it's 4 marks. That's quite a lot for something as simple as that. Start by defining gross profit. Then go on to define net profit. Okay? And then show the differences between them. So what is gross profit? %. It is the difference between your sales, right, or your revenue, and then your cost of sales. Okay. Then net profit. Net profit is what? Again, you can also lean on the formula to help you. What? After all additional expenses. Okay. So we've defined the two. Okay. Now we then can speak to the differences. What are the differences? You guys basically highlighted them in your definitions. Gross profit only accounts for what expenses? Cost of sales, right? Or the costs associated to our inventory or the costs associated to the services, our final product. Does it make sense? Okay. And then your net profit. All your other expenses, okay? The fixed, variable, all other expenses, okay? And then you can start to give examples, okay? And you can also then speak to net profit is the reward that owners are entitled to for undertaking business. Okay, remember, the owners, the shareholders, they get into business to make a profit, isn't it? So that's their reward. We might not pay all of it out, but that's their reward. Okay, we together there. So think a little bit out of the box to try and add a little more flesh to your answer. Okay, because again, 4 marks is a lot. So clearly they want you to share a lot more. Okay, right. Then also here, you've got your asset test ratio. And we know that's current assets minus your inventory divided by your cost of sales. Okay, so yeah, so here you're going to take the inventory at the end of the period. Can you see they gave us 30 June 2022? That's not what we're going to use. We have to use the 209,000. Is that what you guys did? Oh, sorry, that's inventory. I forgot about the current assets. So before you can even do anything, you need to obviously get all your current assets. Cash and cash equivalent is a current asset. Debtors, current asset. Prepaid expense is a current asset. Okay, inventory is also a current asset, but we are not going to use that because we're doing the asset quick test ratio. Furniture and so what I would actually do is I would label all of them. All right. I think that makes your life easy. So this is an income. This is an expense. This furniture is a non-current asset. Land and buildings, non-current asset. Creditors is a current liability. Tax payable, what is tax payable? It's a liability, current liability. 15% long-term loan. It's a what? Then you have a retained profit. Balance of the previous year, 80,000 retained for the current. Okay, this is obviously what? What is retained income? This is just a breakdown, isn't it, of this 100,000. What is retained income? Or retained profit? I'm actually giving you the answer. It's income. Okay. Right. So here we are. So what did you get for your total assets? Your current assets? When you added them up. You guys did this, isn't it? What's our current assets? This is 2024, yeah. Is it? Didn't I upload it to ARC for you guys? Yeah, I know some of our students couldn't find it, but I uploaded it to ARC under your assessment. It's there, ne? Okay, just making sure. Maybe I was worried it might be another group. Okay, so what did you get for current assets? Okay, 169 minus the inventory. Okay, no, it's fine. 169. Yes, after inventory. No, it's fine. We'll work with it. Then your current liabilities, anyone? You should have gotten 160 for your current liabilities. Okay? So then our ratio is obviously 1:2. What do we get when we say 169 divided by 160? Hey, they gave you 13 marks for this. So can you see, if they're giving you 13 marks, it's because of all the adding that you needed to do. So if we don't know what our accounts are, then we're going to have some problems. Okay? Yes, you have to. If you don't know the formula, yeesh, might not want to even come. It will be pointless. Okay, you must know these formulas off the top of your head. Remember, I told you guys you must create a formula sheet, isn't it? Okay, so that when you're now doing it, it's just formula sheet here, and then you're going question after question after question after question. Go back to your textbook, question after question. Okay. So what do we get? 169,000 divided by 160. What do we get? 1.06. Okay. Now you must comment as well to say, is this good or is this bad? What? Yeah, better safe than sorry. And especially if you're seeing 13 marks. Definitely. Comments? Mm-hmm. Uh-huh. It's 0.6 above our current liabilities. For every 1 rand of liabilities, we have 1.06. Okay. So we have more current assets than current liabilities. What else would you say? Is it 2-to-1 for asset test, or is it 2-to-1 for your current ratio? Nope, it's not the same. Because here we have to acknowledge that we are saying minus inventory. Guys, can you even see? Say something. Can you see? Oh, man, I would not have been able to see that. So, can you see? We have taken out inventory. So, here, as long as we have 1:1, then we're happy. If we have more than that, great. Okay, that means we're really in a healthy place. Because in essence, what are we saying? Can we meet our short-term financial obligations without any of our trading inventory? Which means the cash in the bank, what other sources of petty cash, all those other current assets, can they cover our short-term obligations? Can you see that? So here, 1:1 is fine. Okay. But the current ratio, which we're going to do now, yeah, well, it's fine. It's adequate. All right. We're not saying it's great, because I mean, if it was 1.5, then we'll say this is good. This is great. Does that make sense? But 1:1 is adequate. We can live with that. Okay. Because it's not like we've just thrown away our inventory. We still have it. But we're just saying, worst case scenario, can we cover our short-term liabilities? Okay. Assuming we don't have inventory. Okay. So what is our current assets? Total of our current assets. Three, 7,800. Huh? And our current liabilities is still the 160. So here you can already see it's probably what? 2. Yes, 2 point something, ne? 36 is to 1. Okay. So here's where we want 2, at least. And here we have 2.36. So this is good. Happy. Okay. I would say, considering that for every rand of current liabilities, we have 2.36 current assets. Therefore, this business is liquid in that it can cover its current liabilities with its current assets. Okay. Then I would go on to say, what else would I then say? You can leave it at that. Though the key point is you're speaking to the figures that you have, and then you are then saying, what does that mean? It means that the business is liquid, meaning to say we can cover our short-term, because current liabilities is obviously short-term financial obligations or commitments, okay, with our current assets. And if you want, you can even go on to say, which means that we have a healthy amount of short-term debt in the business. Okay, you're allowed. What I want to give you is the keywords to make sure, because not everyone's going to say it the same, but just make sure, speak to the numbers. What are we addressing with the current ratio? And this is where we see what you know. What we measure with the current ratio, the quick asset test, is liquidity. Okay. Problems when we can't meet our current liabilities. Happiness when we can meet our current liabilities. And then showing me that you know 1 is to 1, we're happy. 2 is to 1 for the current, we're happy. That's it. Okay. So here, now, debt collection period. And thank you for asking that, because that interpretation, we'll be looking for it. So here, what are we measuring with the debt collection period? We're looking at how long does it take our debtors, the people that owe the business, to pay us. Okay. So we know the formula is your debtors, okay, divided by your credit sales. Okay. Now sometimes they'll give you debtors from the beginning of the year and that of the end. You'll get your average debtors, you divide by 2, isn't it? But here you can see they've only given us one amount for debtors, and they haven't given us anything under additional information. Okay. So then we say, checking, what else do we have? Yes. So then we say, okay, what was our debtors? This was extracting straight from the table. It wasn't anything fancy. What was our debtors? 103,000. And then our creditors, how much? 105,000. Okay, times 365, isn't it? And this is obviously days in the year. Sorry. I'm also just realizing that was a mistake. I've taken creditors. Is creditors the same as credit sales? It's not the same. Okay, so thank you for that. Okay. I was also noticing here it wasn't matching with what I have. So, but we are using debtors. Okay, so here we're happy. Now, how do we get our credit sales? Did they give it to us? All sales are on credit. Okay, all sales are on credit. So that means that this total is then what? Is then credit sales, isn't it? Okay. Why? Copy and paste. 1,680,000. So then what is our answer? And can we leave it like that? Days. Okay, very important we know. This is days, is this percentages? What is this thing? Yes, you can actually round. Or what would we round to? What would we round to? I would actually round up to 23. You know why I say this? Because you can't get 0.38 of a day. Does that make sense? So because you can't get 0.38 of a day, it's better to include the whole day. Okay? Because if we say 22, are we really being accurate? Does it take 22, only 22 days for them to pay us? So, but yeah, if you left it at this, you would get your marks. But yeah, in the industry, this is actually what we want to see. So it's good you're raising that. So what are we then saying? What would be our interpretation? Because we can't just leave it at that, is it? Remember, sometimes they ask us to calculate the average. They call this the average debtors collection period. So when you're interpreting, you're saying, on average, it takes our debtors 23 days to pay us. Remember the keywords on average, and then you go and look at what you just punched, say how many days or the period, and then make sure to make mention that is the time frame in which you then receive your money. Okay. Based on the calculation above, comment on the liquidity position of the company. Now, can you see they're combining these ratios and wanting you to now give us your professional opinion? Okay. So what did we see? We saw that, again, we are only looking to the liquidity story, isn't it? So we would not include the gross profit because gross profit has got nothing to do with liquidity. Can you see that? Okay, net profit and stuff we're completely ignoring. So we start with the asset test ratio, okay? Then we move on to the current ratio, okay? And it's fine, you can speak of them in any order, but we're just saying the ones that are relevant to the story of liquidity. And would we include this debtors collection period? I would include it. I would try to include it. What I was looking for now is to find out if there was an industry standard. Can you see here? Actually, there is. So here you can see it takes on average 20. Okay. So take advantage of this to include it in your notes. Remember, I said when looking at ratios, you are comparing. It's very hard to have an opinion with something that's in isolation. Either you're comparing with previous years, or you're comparing with your industry, or you're comparing with similar companies. Okay, but you're comparing with something to give you a bit of a story. So here we see our debtors paying us back. Remember, we did the schedules. The schedules is Learning Unit 3 and onwards, I know. But the whole point is we are monitoring to see how long does it take for our debtors to pay us so we know when we have cash. So this collection period, debtors collection period, can also be included, can you see, in your story of liquidity, especially since they've given us what the industry average period is. Okay, so speaking to our asset quick ratio, for the industry, it's 0.72. We had 1.06, I believe. Okay, so in comparison with the industry, it's better. We have a healthier liabilities to current assets, excluding inventory. In comparison with your current ratio, we had 2.3 something. Okay, again, it's healthier. And then obviously the time it takes for us to get back our money from or get our money owed to us by our debtors also takes shorter than the industry average. Okay, particularly here is where you really want to refer. Because for different companies, the collection period, the desired collection period is different. Does that make sense? So you're including all of that, and then you're saying this business is obviously in a healthy liquidity space, right? It's got a healthy amount of liquidity, right? When comparing with the industry, and also just looking at the desired ratio for the current and test. Does it make any sense? Okay, so I'm just giving you the keywords. You know how to best structure. Okay, so this is where they said all of the sales are on credit. There was no change in the amount of gold components. Okay. Right. So that was that. All right. That was that. And on top of that, if you wanted to, here you would have really shown that you know your story. Can you see this? Creditors settlement period. Can you see that your creditor settlement period is longer than your debtors collection period? So it means that we get money back from our debtors before we actually pay those we owe. So can you see that also helps us, because that means that we get more cash from those that we owe before we have to actually settle with those that we are owing. Does that make sense? So that also you can include in terms of this business is in a good position from a liquidity standpoint. Oh, there's only question 2. And then question 1 was theory. Yeah? Yes, we can do it. We can discuss it. We can discuss it. Okay. So, yay. The mark allocation. You guys are going to be writing me essays. What I will advise, especially with this 10 mark type allocation, 5 mark allocation, make sure you have a pencil and then quickly write, even on the test paper, bullet point, how do I want to structure my response to this theory? Because sometimes you can just see that this person was writing as they were thinking. And what they were writing is not necessarily wrong, but the manner in which they relayed their thoughts is not really, it's not compelling, okay? And it's all over the place. So you want to string it in such a fashion that it's easy for the reader to follow and to buy into your chain of thoughts. Does that make sense? So here, with question 1, I'm going to tell you how I would then approach it. So how I would approach it is, firstly, before you even begin differentiating, you need to define what is profit maximization, what is wealth maximization. Okay, that is where I would start. Look here, I think we could be gracious. We could give you 2 marks for defining each of those. So that would give you 4 marks. So here, shareholder value means to maximize the value of the firm, thus maximize shareholder value. Okay, right. Shareholder value, then profit maximization entails maximizing the bottom line profit, okay, and will most likely be measured by earnings per share. Okay, so then now you already have like 4 marks. Now you start talking to the characteristics of both of them. Okay, so here you see shareholder value is realized when the intrinsic market value of a firm increases. Okay, intrinsic, we're basically saying the true value. Okay, the value when you do your analysis as a finance professional, Remember, we have technical and we have fundamental. When you use those and you see this business is either valued higher, the intrinsic value is actually higher than the market value. Market value is the price we're paying for it, okay? And then, or it's lower. That will then be your intrinsic value to say, okay, after analysis, this is the value of the firm. All right? Okay, sorry, I didn't finish that sentence, so let me start again. Shareholder value is realized when the intrinsic market value of the firm increases in real terms consistently over a certain period, okay? So when we're talking about wealth maximization, we're talking about increasing the value of the business over a period of time, okay? Shareholder value is therefore the growth of the investment. So you see, that first sentence, you're getting a mark. This one, you're also getting a mark. Is therefore the growth of the investment value to the shareholder over a period, okay? There are basically two main factors that contribute to growth of shareholder value. And these include dividend growth. Remember, your shareholder gets a dividend, that's part of their return, and the market price, the share price, if that also grows. Okay, can you see how we're now maximizing shareholder wealth? Okay, because when we calculate the capitalization of a share, we're basically saying, in other words, the value of a company, capitalization of the company. We're saying the share price times the number of shares. Sorry. So if we increase the shares from 5 Rand to 10 Rand, okay, and let's just say you had 10 shares, can you see your capital in the business, okay, because we're talking about a specific investor, né? Business could have 100 shares, 1,000 shares, who knows, has moved from 50, 5 times 10 shares, to 100. Can you see that? We've increased or we've maximized shareholder wealth, okay? Which is why we often talk about the share price in connection to shareholder maximization. What do we talk about when it comes to profit maximization? How do we measure that? We measure that by your EPS, earnings per share. And also when talking to profit maximization, it's very short term. We're only concerned with how do we get the highest possible bottom line, okay? So you'll see that to kind of differentiate, you're leaning into the definition and then you're extracting characteristics from your definition, okay? Right. So then that should obviously, I want to see if there's anything I missed, what I wrote. EPS does not take into consideration, earnings per share does not take into consideration timing of cash flows or any risk to the business, okay? Remember what we said as financial managers, we only take on risk, right? Necessary risk. If you're just chasing profits, you may take on excess risks, okay? Not taking into consideration the depth of those risks, okay? Right. So I think we've dwelt with that quite thoroughly, okay? I'm also going to share these suggested solutions with you guys, okay? I just want you guys to attempt them. So what I'm going to do is I'm going to create links. I think I said this earlier. I'm going to create links for you to put in your answers. And then you guys are writing on Wednesday. Yeah. So I'll make sure by Sunday that I've uploaded my suggested solutions. Yeah. Oh, you know what? It's fine. I'll just upload them on Friday because yeah, Wednesday is not that far away. Okay. So that was 1.1.1. Oh, we still have time. Discuss the agency problem. Okay, and include suitable examples. Okay. So here they even told you discussion, 3 marks, and then examples. All right. So what is the agency problem? Yes. Yes. Mm-hmm. Okay. Pick them, manipulate things or do things that are not in favor of the shareholders. So here it's just about keywords. Okay. Number one, conflict of interest. And it's not just the finance guys, okay, but we're obviously discussing financial management. Conflict of interest, okay, between who? Your managers and your shareholders, okay? Your shareholders do not have as much information into the day-to-day runnings of the managers, all right? Or let me say, of the business as much as the managers do, okay? Right. Now, when the managers prioritize their own interests over that of the shareholders, that is when you have the agency problem. So we've defined it. Now we need to give examples. And this is why I was asking, is it only pertaining to financial, all right? Increasing my own pockets, lining my own pockets. It's not always just about my own pockets. Does it make sense? But it's about compromising the business. So for instance, if we use a supplier that is related to me, obviously they're going to financially benefit because they have more business. Does it make sense? But it's not necessarily enriching me in any way. I'm just helping out a relative. Does that make sense? They are cheaper suppliers, but we're choosing my relative. Can you see how we are compromising shareholder wealth because we're not effectively using the resources that the owners or the shareholders have allocated to the business? Okay? Conflict of interest. Then, obviously, there's the issue of bonuses. Okay, that's an easy one that you will struggle to forget. If I hit certain targets, okay, achieve certain milestones in terms of sales, it could be anything, right? Then I'm going to get a bonus of 30% as opposed to just a bonus of 10% if I fail to meet that target, for instance. Now, the things that it may require, the risk that I might need to take on to hit that target, all right, may compromise the business or put the business in jeopardy. I'm not concerned with that because all I want is to make sure I get that 30% bonus. Okay, that's the second example. And I know there are other examples. Do you guys remember any other examples that you may have come across or have written down from your textbook? And what's important is you show me in your examples clearly the agency problem taking place. Does that make sense? Okay, and you'll be home and dry. Then here, the last one, we'll take a break. Explain the measures that shareholders can implement to minimize the agency problem. Explain the measures. What causes the agency problem? So if we align my objectives with the objectives of the business, is there going to be room for there to be conflict of interest? So that is definitely what you want to highlight there, to say the business can ensure that the objectives or the goals of your financial manager are in alignment with the goals of the business. Okay, that will definitely reduce your agency problem. You can also speak to policies that are put in place, and then use the example, for instance, of that will prevent financial managers from conducting business with relatives or with their own enterprises. Because I can set up a company and then say, we're going to be buying paper for the printers from that business. Does it make sense? Okay, so must sign off, create policies for checks of this nature. Okay. Also, in addition to that, more transparency. Isn't we're saying the agency problem comes about as a result of I have information you guys don't have as shareholders. All right. So what do we need? Me to be more transparent with yourselves. In addition to that, you can also speak to setting up a board. You know that the board of a company is there to provide governance to the executives operating in the business, in other words, management. Okay. In order to protect the owners or shareholders. So you can see, just need to take a moment with your pencil, write on the side. What are the things that would prevent or counter the agency problem? And then boom, one after the other. You're good to go. Okay. Right. So that is your 2024. Okay.